One of the reasons why TSMC is the semiconductor giant today is Chang's decision to go against the conventional wisdom. Because at the time, every major semiconductor company was vertically integrated. And that means they designed, manufactured, and packaged chips in-house. So they did everything. All leading companies operated that model, but Chang envisioned something different, which was a company that wouldn't design chips at all, and instead it would only manufacture chips on behalf of other companies. That's basically the first pure play foundry. And again, it all sounds simple in retrospect because it worked out so well, but it was revolutionary back then because the idea of just outsourcing your most valuable intellectual property, which was your chip design, to a third-party manufacturer was just insane.
Welcome back, folks, to our Intrinsic Value podcast, where we go through the business breakdowns of different companies every week, estimate their intrinsic value, and then decide whether to add them to our portfolio of stock holdings that we're building over time, slowly but surely. And before we get started, I do have a quick announcement in case you haven't listened to some of our episodes recently. Daniel and I are really excited to announce that we are launching a new community for investors in our audience to join. This will be an exclusive community where we vet every member and cap the total size of the community to basically ensure that it stays at a meaningful and intimate size so that everybody can know each other and share ideas. And for a limited time, we are opening up 30 spots. So if you want to join and that sounds interesting to you, we have a wait list at theinvestorspodcast.com/intrinsic value community. And yeah, spots are going to fill up quick. So I would jump on over that as soon as you listen to this. For the applicants, if admitted, you'll have the chance to network with other like-minded investors, share stock ideas and get feedback on pitches, dial into calls with expert guest speakers, and also just get the latest updates on Daniel and I's portfolio of investments and really so much more. So I think it's going to be really special. And like I said, if you want to learn more about it and join the wait list for one of those limited spots, just go to theinvestorspodcast.com/intrinsic value community. And we'll also have a link in the description for this episode below. So with that, let's get into our episode today on what might just be the most important company in the world. And that is really not hyperbole. I'm actually not even talking about Apple, NVIDIA, or Microsoft, or actually any American company for that matter. In fact, all of these companies have one thing in common, and that is that they rely heavily on TSMC, Taiwan Semiconductor Manufacturing Company. So TSMC is critical for how our modern world works, powers phones, laptops, data centers, electric vehicles, and even defense systems. And the underlying technology enabling them is increasingly made by one company, like I've said, TSMC. And while that company is based on one very geopolitically sensitive island, it produces at a level no one else can match, which I think Daniel will tell us about more in today's episode. And it is arguably only going to become more important to the world as AI adoption accelerates. That is what we'll be diving deep into now. So Daniel, I expect this to be a very enlightening episode. I definitely have not fully grasped why no one can do what TSMC can do. And some say that semiconductor manufacturing is quite literally more complex and harder to do than rocket science. And I will defer to the rocket scientists of the world of whether they agree with that. But I think technically speaking, I stand zero chance of understanding this. But still, hopefully at a high level, you can explain what is going on and what makes TSMC so special.
Well, I hope so. I actually got the idea from a talk I had with some of our members in the community, and we have a few members who are highly knowledgeable about semiconductors and have vouched for just how wide TSMC's moats really are. So, of course, I knew the company before, but I wasn't aware of just how crucial it is to all the supply chains of the companies that you just mentioned, especially in the high-tech world. If we look at TSMC's revenues and the breakdown, we see that high-performance computing makes up nearly 60% of revenues, and it just keeps growing year by year. And that category includes the usual suspects. So we are talking NVIDIA, AMD, Apple. All these companies rely heavily on TSMC for their chips. And Apple is basically responsible for about 20% of TSMC's business, which is not too surprising if you think about all the products that rely on chips: iPhones, iPads, MacBooks, and even those little Apple Watches. NVIDIA's share of revenues also exploded in 2024, so they are now close to Apple's revenue share. So both of them are about 20%, and that's 40% of TSMC's absolute revenues. So you could argue that there's concentration in TSMC's business in two aspects. The first one would be the high performance computing and the smartphone segment, and then that they're just two companies making up so much of their business. But I think we will see over the course of this episode that TSMC will always manufacture for the biggest players in the industry. And if those players should change for whatever reason, TSMC would simply supply the new market leader. I've recently watched an interview with Shawn. I think you watched the same interview, and he's a fantastic investor.
It was a really great interview.
It even went a bit viral on Twitter. He's a fantastic investor who has outperformed the market by a wide margin. And he talked about how he tries to go about choosing companies to own. And because there are so many unknowns, he likes to think about whether the company he looks at will still be around in 20 or 30 years. And after discovering just how important TSMC is for the modern world, you would think it would be in almost every quality investor's portfolio who goes about choosing companies like that. And of course, it is owned by many of them, but not by all of the big names. I guess we'll take some time today and talk about why that is.
Well, I'm obviously no expert on the chip sector or TSMC, but my understanding is that, as you said, TSMC kind of checks every box that somebody that Chris Hone, who focuses on these natural monopolies, would look for. Really dominant market share, massive, massive barriers to entry. And yeah, there's still some hesitation in a ton of investing circles. I was just at a conference this past week where basically everybody was debating whether you could own the company like TSMC. And so, not to spoil anything about the episodes here, but I think we all know that geopolitics will play a big part in the conversation for this episode today. So I just really want to understand, though, why TSMC is supposedly irreplaceable, and from your research, whether you came to a similar conclusion. And then from there, we can try to think about, if possible, how to even factor in those geopolitical concerns into the valuation. So before we get too far ahead of ourselves, why don't we take a step back and talk about how TSMC got to where it is? How did it get this monopoly? So maybe you could just tell us about the company's history and founding story.
Right. So maybe the first thing we should do is clarify the difference between designing and manufacturing a chip, because that difference is crucial to understanding TSMC and basically the entire semiconductor industry. Manufacturing is probably self-explanatory, but I didn't know what exactly the designing part meant before I first dug into it. So basically, you can imagine designing a chip as drawing a blueprint for it. So the design tells the chip what to do, how to process information, how to store memory or power graphics, kind of like planning how all the parts of a car engine will work together. Once that blueprint is ready, a company like TSMC steps in to actually build it, layer by layer, on a piece of silicon. Understanding this is the baseline for understanding the radical shift that Morris Chang, who is TSMC's founder and former CEO, did, and also his story, which is quite unique. He was already in his 50s when he founded TSMC back in 1987, and he had a long journey to get there. Chang is actually not Taiwanese, but Chinese, so him ending up in Taiwan is not because he had a special connection to that country. It was just a series of coincidences. Chang moved from China to the US when he was 18 to study mechanical engineering at Harvard. And he did end up getting his bachelor's and master's degree, but not at Harvard. He transferred to MIT just a year later and even tried getting a PhD, but he failed his entry exam twice. So he decided that perhaps academia might just not be for him. And then he went on to work in the industry. He eventually ended up at Texas Instruments, TI, where he spent nearly 30 years. And he quickly made a name for himself by improving TI's so-called yield. And yield is a term used in the industry. It measures the efficiency and quality of the manufacturing process, indicating how many usable chips you obtain from any given batch of wafers. So if you produce a wafer that has 100 chip dies, but only 60 of them are functional, then your yield would be 60%. And the higher the yield, the higher is your margin. And TI was so convinced of Chang's talent that they actually told him to take another shot at getting his PhD, and they would pay for it as well. Not only the PhD, but also his salary. And this time, it finally worked out, and he got his PhD from Stanford, so not MIT anymore.
It's amazing how so many of the world's leading tech founders are like always tied to Stanford. Even when they're not setting up shop in Silicon Valley, they still seem to have always crossed paths at that university. And even if it was just for a fleeting period where, the usual story is like, yeah, we went to Stanford and we had some brilliant business idea and we dropped out after our freshman year. But in this case, Chang kind of has a story like that, but he actually went all the way to get his PhD at Stanford. And which I guess, if you're going to work in semiconductor manufacturing, you better have a PhD.
Semiconductors might be a bit too complex to drop out of your bachelor's degree. That's true. And Chang had his eye on the CEO job at TI, so he really had to be very good. But despite his great work and long tenure, he didn't get the job. And some rumored it was because he was not American, but Chinese. So he decided to eventually leave the company and to achieve his dream of leading a semiconductor company somewhere else, not at TI. He then joined General Instrument Corporation, another semiconductor company in the US, and it wasn't on the same level as TI, but this is the company where he could finally achieve his dream of becoming a CEO. However, once again, it kind of took a bad turn and his bad luck continued as he quickly realized that General Instruments played a totally different game than TI. Chang was a researcher. As you said, he got his PhD. That's what he liked to do. And that's also what he was good at. But at General Instruments, the culture was totally different. General Instruments was more of an acquirer at that point. So they flipped semiconductor businesses, bought them cheaply, and then hoped to make a profit selling them at a higher price to other competitors. And that's not what Chang imagined to do. So once again, he left after just a year at the company.
Sounds like he really got around before finally founding TSMC. And I think the story gets even more interesting at that point, though, right? I've actually heard some of this founding story before of TSMC. And correct me if I'm wrong, but after spending the majority of his life in the US, by now, it seems like he kind of out of nowhere got a call for this new opportunity. And not from another company, though, but from the Taiwanese government, I believe. Specifically, I think it was Premier Sun Yun-swan invited him back to Asia to lead Taiwan's new tech research institute, ITRI. And it was a big ask, helping Taiwan build a semiconductor industry basically completely from scratch. And Chang took the job, unsurprisingly, and that move, more than anything else, changed the course of his career and really Taiwan's and the world's trajectory. And backed by the government, he was tasked with turning Taiwan into a global chip powerhouse. So while he was the founder and face of the company, it was really basically a government project, and he kind of was responsible for leading it. But is that right? Tell me if I'm messing up the history.
I couldn't have told it better, but it was more of a risk than you might give him credit for, because at that time, Taiwan was not known for manufacturing any high-tech appliances. So getting into chips and basically build that company out of nowhere kind of meant leaving his dream of leading a probably US semiconductor company behind, and then starting into a new venture that pretty much could go anywhere. And this story is also why the insider ownership in TSMC has been pretty low throughout its entire history, because usually founders have a big stake in their companies, especially in high-tech and founder-led companies. But Chang had no equity in the business at all. He just got his salary like everyone else, and about 50% of the company was owned by the Taiwanese government, and the other 50% was split between private investors and the Dutch company that you probably know, which is called Philips, and that company took another 28% share. Philips brought in capital, early customers, and also shared manufacturing know-how, which helped a lot for TSMC. And that's why that partnership just gave TSMC credibility and helped it getting into serious commercial production with their chips. TI or Intel, by the way, could have also gotten that deal, but they declined TSMC's offer and even more so Chang's personal offer.
One of many wrong decisions that both of those companies would make in the coming decades. I asked myself, though, how Chang could become a billionaire without getting any equity in the business, as you alluded to. And when I looked it up, it turns out it seems like he actually just bought so much stock from his regular salary that over time, that was enough. And obviously the company had enough success to make him a billionaire. And I just think that's such a cool story. Nothing was given to him. He built it from scratch, and he didn't even have the advantages of getting rich in the usual way when you build something from scratch. He basically built the company the hard way and made money the hard way too. And that's just an unconventional move for a CEO, and something that is probably really inspiring to a lot of people. And it just showed his conviction in the project. But yeah, let's talk about his big innovation now. You mentioned the difference between designing and manufacturing chips. So why does that matter today? What is the consequences of that?
Well, one of the reasons why TSMC is the semiconductor giant today is Chang's decision to go against the conventional wisdom. Because at the time, every major semiconductor company was vertically integrated. And that means they designed, manufactured, and packaged chips in-house. So they did everything. All leading companies operated that model, but Chang envisioned something different, which was a company that wouldn't design chips at all, and instead it would only manufacture chips on behalf of other companies. That's basically the first pure play foundry. And again, it all sounds simple in retrospect because it worked out so well, but it was revolutionary back then, because the idea of just outsourcing your most valuable intellectual property, which was your chip design, to a third-party manufacturer was just insane. It must have sounded insane to every company that he reached out to. One of the reasons they still did it was Moore's law. And Moore's law states that the number of transistors on a microchip doubles approximately every 2 years. Although it's important to say that this is not actually a law, it's more of an observation made by Gordon Moore in 1965, and that's where the name's coming from. But the progress was going so exponentially fast, and costs also, they pushed higher and higher, that fabs were just getting more and more expensive, and the tools you needed more and more specialized. And because of that, the scale required to stay competitive in the space was going faster than even the biggest chip makers could handle.
So TSMC's value proposition was to simplify the operations of these vertically integrated companies by offering to handle the chip manufacturing for them. It was manufacturing as a service, and perhaps the most specialized types of manufacturing in the world. And because that's all they did, they achieved the scale and the expertise and really just the practice to build the highest in chips better, faster, and more reliably than anyone else.
Right. TSMC basically took on the burden of high capital intensity in manufacturing for its clients. And that's a pretty strong value proposition because the business is not only capital intensive, it's also cyclical. And that's a very unpleasant combination, as you can imagine. So if you have enough scale, you can do it, you can make it work. And that's basically what TSMC did. And by doing that, they started what's now called the fabless revolution, where more and more companies outsourced the manufacturing. NVIDIA, AMD, and Apple's internal chip divisions all embraced that model. And because all those big players went to TSMC for the manufacturing, TSMC became this pretty much monopoly, and its market share just exploded. In the early 1990s, TSMC had just a small slice of the foundry revenue, but by 2010, it controlled more than half of the global industry. And today, it has over 90% share of the world's leading edge chip production and about 60% of the foundry market.
That is just an incredible economies of scale advantage that reinforces itself. You have the most money to spend on R&D, and then with that, you can attract the best talent. And then just literally having scale like that in manufacturing can enable you to be the lowest cost producer because you can spread out those fixed costs over a wider revenue base. But still, when you think about how much of the global economy runs through this one business, it's almost an exception to the rules of capitalism to have such a profitable and important business, not necessarily protected by any kind of government mandated monopoly like a railroad or utility, be so poorly challenged by competition. And really, the best to think of is Alphabet for the last 20 years with Google search. It's been this honeypot of profits that everybody has wanted to get into, and no one has really been able to disrupt it, at least not yet. But let me ask you, what is so special about the chip market that makes it such a winner-take-all industry that has seemingly left no competitor able to catch up?
To really understand TSMC's dominance, we have to understand just how brutal the economics of this industry are. So first, let's talk about cost. Building a leading-edge semiconductor fab today easily costs $20 billion or more. I know many companies who plan to spend $100 billion or even $200 billion, Samsung, for example, in the next 10 to 20 years just for new fabs. And a big part of that, the costs that you need to have these new fabs built, is the machinery. You need ASML's extreme ultraviolet lithography system. In short, it's EUV. And those are some of the most complex machines ever built. Each one costs upward of $150 million, and it's as big as a double-decker bus. And you need dozens of them. A little fun fact, going back to the earlier section about TSMC's history, the Dutch company Philips that I mentioned also owned about 70% of ASML at its IPO. And just their TSMC and ASML investments would have been worth like 50 or 60 times the amount that Philips' market value is today. So I think it's safe to say they kind of missed out on a lot of money, even though both of those companies did phenomenally for Philips. But getting back to the economics, if you look at TSMC's growth capex, you can get an idea of how capital intensive this industry really is. They spend at least $30 billion a year in the last 5 years, and that is expected to grow in the years ahead. And while that's often labeled growth capex, I think in this industry, it's probably more maintenance. If they stop investing, they would also stop being at the forefront. And if you're not growing in this industry, then you're declining. That's the flip side of winners takes it all market. The good news is that these investments result in more growth for the business very quickly. So if we look at this chart, which basically shows you year-over-year revenue growth and year-over-year capex growth, we can see that whenever capex spikes, revenue growth immediately follows the year after. And that's also why TSMC has such high returns on capital, despite the amount of reinvestment and the time it takes until it's up and running and producing the same yield as other factories. In years with lower capex growth, returns on invested capital are in the mid to high 20s or even higher. And when capex rises a lot, TSMC still earns 20% returns on invested capital. Perhaps what's an even more important number for TSMC is its incremental return on invested capital. So ROIC in short. And that measures how efficiently a company turns each new dollar of invested capital into profit by comparing the change in net operating income, in short, NOPAT, to the change in invested capital over a specific time period. For the last 5 years, that return has been in the high 30s. And I didn't even subtract cash when I calculated it. So if you would do that, returns would be much higher because that's a big chunk of money that's generating much lower returns. If you enjoyed this show, I would bet that you would love our Intrinsic Value community. It's a private network for sophisticated long-term investors who care about deep research, sharing actionable investment ideas, and making meaningful connections with like-minded individuals. Besides reading all the value investing books I could get my hands on and doing my own valuation work, nothing helped me more than getting feedback from a group of sophisticated investors with diverse backgrounds and distinct circles of competencies. We also host calls with a variety of experts and investing professionals who share their unique strategies and insights with our members. But we are only opening up 30 spots for a limited time. They will probably fill up fast, so if you want to invest better and surround yourself with people who do the same, you should join our waitlist for the Intrinsic Value community at theinvestorspodcast.com/intrinsic value community. That's theinvestorspodcast.com/intrinsic value community.
Hey guys, this is your host of the Intrinsic Value Podcast, Shawn O'Malley. Just like everybody else, there was a time when I was a beginner investor, and I have to say, investing is particularly filled with jargon that can just make it so difficult for new investors to understand what is going on. But it's never too late to get smarter about stock investing from the ground up. At the Investors Podcast Network, we've made a habit of studying the world's best investors, and now I'm distilling those learnings into a simple course for you, or for anyone in your life who you might want to share the gift of knowledge with. With my How to Get Started with Stocks course, you can master the principles of excellent lifelong investing with valuable insights for both beginners and pros. The course covers 10 different sections, beginning with the basics of what a stock actually is and how the stock markets work, to strategies to optimize your retirement savings, how to pick great companies for the long term, what to look for in ETFs, and how to monitor your investments, plus so much more. To begin getting smarter about investing, just visit theinvestorspodcast.com/get started with stocks. That's theinvestorspodcast.com/get started with stocks. And for a limited time, you can use code STOCKS15 for a 15% discount at checkout. We are value investors. That's the whole point of this show. So of course we love to make a little extra money. And for someone who loves to travel as much as I do, like I just did to Austin, Texas for a friend's wedding, you really need to take advantage of all of the small ways to make a little extra money when you can. Fortunately for me, and for anyone who travels frequently or has a second home, using your house as an Airbnb to earn income with is the easiest it's ever been, thanks to Airbnb's new co-hosting network. All I had to do was provide the space, get paid, and they handled everything else. It's that easy. With Airbnb's co-host network, you can hire a sophisticated co-host to take care of your home and guests without the stress. One of my childhood friends' family owns at least 2 vacation homes that I know of, one in the mountains and one at the beach, and it blows my mind that they don't list their home on Airbnb as a way to monetize those properties that are, well, let's be honest, empty for most of the year. They would be the perfect candidate for working with a co-host through Airbnb. If you have a second home, travel often, or away for extended periods of time, go find a co-host at airbnb.com/host and start earning extra money today. It's funny, and I mentioned it earlier in the call, but I was just at this ValueX conference, and one of the conversation points at the dinner for the event was around this theme of great rotations, basically, these big changes in the status quo, with one of them being premised around big tech companies, and not just whether they'll mean revert toward making up a smaller portion of major stock indexes over time, but also this question of whether their business models are fundamentally shifting. And you can imagine it was a big point of debate. Everybody's got opinions on the Mag 7, but it's because they're spending hundreds of billions of dollars on CapEx over the next few years between each of these Mag 7 companies on AI related infrastructure, with the kind of the point of the question being, will the Mag 7 still be such capital light businesses? You know, that being what has made them such special companies to own over the last 2 decades. And if not, will all of this CapEx spending reduce the quality of these businesses over time? And yet with TSMC, as we've seen here, it is possible to still, if you have wide enough moats, you can still have a very high quality business, even if the business is highly intensive in a way that Google or Meta aren't. And if most of their CapEx is going toward growth, allowing them to produce even more cutting edge products that create even more value for the companies that use these chips, they can charge higher and higher premiums for those high end chips, while also still manufacturing the lower end chips for less cutting edge purposes. And I'm thinking about like the chips that might power a smart refrigerator that's connected to Wi-Fi or something silly like that. But yeah, I'm not sure if there's any like a cannibalizing element there where you are always unlocking the benefits of the next wave of leading edge chips with growth CapEx, but you're also disrupting yourself to some extent because your previously cutting edge chips are now no longer at the forefront and then by default less valuable. So it's probably a little bit subjective how you define maintenance CapEx versus growth CapEx in this industry, since you almost have to invest in growth to maintain your competitive positioning, which is normally what we would think of maintenance CapEx. But it's just such a fast changing industry, regardless. The company is investing heavily in protecting and to differing extents still expanding its moats, which is what ultimately matters. That moat is what will enable the company to generate excess returns on capital for long-term investors.
And even if we want to stay in the framing of growth and maintenance capex, since TSMC has a much higher yield than its competitors like Samsung or Intel, they're also below the industry average for maintenance capex, which leaves even more room for investments in growth, building out scale, and then, once again, manifesting their position. This brings us to the next point, which is the actual manufacturing process. And it might be the most sensitive manufacturing process in the world. The air has to be cleaner than in a hospital, and vibrations from nearby roads can destroy an entire wafer. You're literally building transistors smaller than viruses and billions of them, and then layering them onto silicon wafers with nanometer precision. And because the process is so sensitive, the outcome can vary a lot for different factories and even more so for different companies. And that's where TSMC really differentiates itself from the rest. TSMC has achieved a yield of over 90% for some of the highest end nodes, while Samsung has only reached 60%. And the difference in the newer generations, the 2 nanometer nodes, is even larger than that.
All right. So we've talked about how TSMC changed the game with the foundry model and why chip manufacturing is one of the hardest, most capital intensive businesses to be in. But let's dig deeper, shall we? Because if we're going to say that TSMC might be the most important company in the world, we really need to unpack what makes it so dominant. What are the other layers of their moat? What makes it so hard for anyone else, even someone with lots of money, to replicate TSMC's position? And I imagine a company like Apple or Amazon would have the money to get into this business if they really wanted to.
In our Amazon episode, we discussed that they will spend more than $100 billion in capex this year. So yes, money is not necessarily the problem. But as you know, sometimes you should outsource a part of your business when it's more profitable to do so. And that has been the case for a long time. But of course, that's not the only reason. Companies like Apple or Amazon would create these chips in-house if they could. That would save them a lot of dependencies that they would likely want to avoid, especially in times of increasing geopolitical uncertainty. So let's break down TSMC's moat in more detail and find out why Munger would have probably called it a Lollapalooza mode, which is many competitive advantages stacked on one another. At the core, you have process technology leadership. TSMC has consistently been the first, or at least the fastest, to ramp up each new node. They led the transition to 7 nanometers, then 5, then 3, and now they're even working on the 2 nanometers, and it's coming pretty soon. And in an industry where scale is king, the first move advantage is crucial. TSMC's 3 nanometer nodes are already accounting for almost 20% of its entire revenue and growing from just 6% last year. So there's huge growth rates in these higher and high-end nodes. Combined with the other high-tech nodes, they account for over 70% of revenues. That's important since very few other players even compete in that segment. So that's where you lock in customers, and that's where you can charge higher prices. But the older nodes are also important for TSMC. So about this cannibalizing argument, there's a case to make for that. But you need those older nodes since they tend to drive more profits than the revenue share would suggest. That's relatively intuitive since most of the R&D spend is targeted at these newer generations. TSMC doesn't report the actual profitability of its nodes, but just making some rough calculations based on how they account for depreciation and where the investments are going, you can see that the operating profits of the older nodes are higher than their revenue share would suggest. And it's the opposite, obviously, for the newer nodes.
So without mature node revenue, you're not only shouldering enormous upfront costs to develop the next generation of chips, but you're also potentially waiting years before those nodes become profitable. And that's also why yield is so important, right? If Samsung only gets a 20% yield on the newest generation, most of its wafers will produce unusable chips, which makes the economics of producing them less attractive. And TSMC, by contrast, runs this flywheel where they have the profits from older, higher yield nodes, which fund the development of the newer ones. And because of its experience, scale, and ecosystem and everything we've talked about, TSMC will then basically typically ramp up new nodes with better yield sooner than anyone else. And that gives them this recurring first mover advantage, I think, that allows them to attract more customers. And then that boosts scale even further, which again improves yield and so on. And eventually those new nodes become profit drivers themselves. And when the next node comes, the cycle repeats. But could you just give us some insights on who is buying the older ones? Once this technology is no longer the cutting edge, I'm just wondering what the end clients look like. You would think that people only want the most cutting edge stuff, but also you probably don't need the most cutting edge stuff for all of the purposes that we use electronics for on a daily basis.
Well, and if you want the newest, you also got to pay the highest prices, right? So for many products, it's actually not necessary to have the newest ones. It depends on the computing power a product needs. So for example, the latest 3 or 5 nanometer processors are mostly used by companies building high performance chips. Think Apple's A series processors, Nvidia's AI GPUs, or AMD's CPUs. So these are performance sensitive applications where power efficiency and die size really matters. But many industries like automotive or other industrials still run perfectly fine on mature nodes like 28 nanometers or even 65. So when we talked about Mercedes and how they want to increasingly turn their cars into digital products, most of the nodes they need don't need to be cutting edge.
But as we've seen in the revenue breakdown, Mercedes is not the typical TSMC customer, right? TSMC is mostly active in the high-end market. So they focus on the Apples and Nvidias of the world. And I guess that's where this Lollapalooza moat comes together that you used as a term a minute ago. And we know comes from Charlie Munger. And as you kind of touched on, refers to having multiple advantages compounding together at once that sort of makes them untouchable. And competition in the lower quality nodes is more intense, and margins are therefore less attractive. And meanwhile, TSMC's margins look more like a software business than a manufacturer's business, which is just incredible.
Yes, competitors outside of the cutting edge have operating margins between 50 to 25%, and sometimes also lower than that, especially in cyclical downturns. We've mentioned it earlier today, but there are basically only 2 companies in the high-end market, and that's TSMC and Samsung. Intel is trying to get probably back into it, but it's struggling. Global Foundries and UMC used to compete in that segment, but they stopped some years ago because they were just realizing it's impossible for them to achieve the same level of technology and accuracy in building and manufacturing these processors. And on paper, Samsung is the only company that has kept pace in terms of announcing new nodes. But in practice, even they couldn't really deliver. Yields were significantly lower, which hindered volume, and that again impacted profitability. Their foundry division was operating at a loss of over $700 million in recent quarters, and it actually had to shut down about half of its 3 nanometer lines just due to underutilization. And big companies like the Apples and Nvidias of the world, they need stability and reliability. The entire product timeline depends on getting TSMC's product on time. When they would shift to another company, they fail to deliver on that timeline due to lower yields and less volume. Well, then Apple's shelves are empty as well, and Nvidia can't deliver GPUs to Amazon, Alphabet, or Microsoft. And as shareholders of Alphabet, that's the last thing that we want, right? And asked about whether Nvidia plans on reducing its reliance on TSMC, its CEO, Jensen Huang, actually said this.
Do we have any intentions to reduce our dependency on TSMC? No. The reason why we depend on TSMC is because they're the world's best. And they're the world's best not by a little bit. They're the world's best at what they do, like we're the world's best at what we do, by a mile. I mean, it's incredible how good they are at what they do. And it's not just technology, it's scale, but it's also the the deep trust that we have in working with the company and their agility.
I don't think there's anything I can add to this. I mean, the trust he's talking about is often underestimated too, because it's nothing tangible. But as I said, companies need to rely on TSMC or their entire operations fall apart. And especially back in the day, they needed to rely on TSMC to not just take their chip design and then end up stealing it or copying it. Today, that's a given, but it wasn't at the beginning of the foundry business model. And getting to Intel, they are going through a pretty dramatic pivot. Historically, Intel manufactured chips only for itself, and they were really the gold standard for quite a while. But they fell behind mainly after delays with the 10 nanometer and then 7 nanometer nodes. And now they are trying to basically reinvent themselves. They've committed over $100 billion in capex for new fabs in the US and Europe. And some years ago, they actually plan to be back on top of the industry by now. But looking at the numbers, there's nothing that would support that ambitious goal. I mean, last year, Intel's foundry division lost $13 billion on less than $18 billion in revenue, while TSMC generated $41 billion in operating profit on $90 billion in revenue. Intel is no small company, but if these type of losses keep adding up, I think it can get even worse for them than it actually has been in recent years. Perhaps that's also why there have been rumors of a joint venture between Intel and TSMC, but right now TSMC denies any rumor about that.
And to continue the theme of acronyms in today's episode, what about SMIC, which is, I believe, China's largest and maybe most advanced foundry? We already saw in our Uber, Amazon, and Visa episodes that China is sort of always doing its own thing and doesn't really ever want to depend on another country's tech if they can avoid it. So is TSMC's position so strong that not even China can duplicate what they do or provide a competitor here? Or is it true that SMIC is perhaps the Chinese TSMC?
Well, I can definitely say SMIC is not yet China's TSMC, and it's also not looking like that anytime soon. So SMIC is growing fast, and they're getting tons of domestic support, especially as US export controls restrict China from getting the chips that TSMC produces. But SMIC still lags significantly behind TSMC in terms of technology and scale. And the company primarily produces mature node chips, so that's 28 nanometers and above that. And they're heavily constrained by those sanctions. They can't buy EUV equipment, so these ASML machines, and that's huge because there's just no alternative to those machines. Those EUVs are also so complex that it's impossible to reverse engineer how they work. So even espionage, which allegedly wouldn't be completely new to China, wouldn't help them catch up. So SMIC remains a strategic player for China's domestic chip supply, but it's years behind TSMC, and I don't really see how they can get into cutting edge nodes and challenge TSMC anytime soon.
Okay, well, we've talked a lot about TSMC's dominance, but that only matters if there's enough demand to support their business. And right now, that demand is clearly there. You got AI, autonomous driving, and high performance computing, and all of those and more rely on advanced chips. And that shift toward demanding more and more computing power puts TSMC at the center of a booming industry. And a few years ago, there were, I guess, real concerns about whether chip demand could hit a ceiling, especially as it became clear that it would be more difficult to keep up with the expectations of Moore's law and advancements in computing power going forward. And really, the slowdown and kind of stagnation and growth in the smartphone market added to this and was a big worry. The smartphone segment was, for a period, the biggest part of TSMC's revenues. And I think that's not the case anymore. And I guess that debate just feels outdated now. We've moved past smartphones as being kind of the core thing that semiconductor companies are focused on powering. It's just about everything is becoming a semiconductor product, it feels like, even in a lot of industries you might not expect. For anyone who listened to my John Deere pitch on this episode way back early on when we first started doing it, you will know that increasingly their tractors are powered by machine vision. And so, of course, you're going to need cutting edge chips for something like that. So, just to bring it all together here, how do you see the growth opportunities for TSMC going forward as long-term investors in what we think is a really high quality business? How do we think about what type of opportunities will be before them and how that can change over time?
The secular growth trend is as strong as it could get. And as you mentioned, that debate, which was basically held in 2020 and 2021, feels like ages ago, because nowadays you couldn't even imagine how the world would look like without TSMC's products. So to understand where TSMC's growth will come from, we really do not have to look much further than AI. But one sentence on the fear that Moore's law could come to a halt, this would have actually happened if not for ASML's EUV machines. And I know I bring them up a lot today, but they're just at the core of what makes this so impenetrable for both ASML and TSMC. And it really seemed impossible to build those machines. ASML's competitor, Nikon, didn't even try because they actually thought this is just impossible. So ASML is the reason why TSMC can do what they do. And TSMC, in turn, is the reason that pretty much everybody else can do what they do. High performance computing, which includes everything from NVIDIA's GPUs to Apple's M series chips, now makes up over 50% of TSMC's total revenue. And a big part of that is being driven by AI accelerators. Basically, the entire AI supply chain relies on TSMC. That's part of the reason why you saw sales growth immediately spiking after investments. Additional capacity and newer generations of nodes are in instant demand. In 2024 alone, TSMC said that revenue from AI-related chips more than tripled, and they're expected to double again in 2025. And even the sectors that we have only mentioned as demand drivers for lower quality chips, like automotive, and you just mentioned John Deere, will become TSMC customers more and more. And modern day EVs have hundreds of chips in them: sensors, power management, cameras, connectivity, ADAS systems. Some of these will still run on mature nodes, but the more advanced driver assistant platforms, they will definitely push into 7 nanometers and below. So TSMC's automotive revenue actually hit a new high last year, and it outpaced smartphone growth by 2 or 3 times in many of the last years. Companies like Tesla, Waymo, which I know you are very bullish on as well, and even more traditional car makers are working on self-driving stacks, and the further they get, the more they are basically becoming semi-companies.
I was in Austin a few weeks ago for a wedding, and man, it was so cool to see those Waymos up close and personal. Just watching them zip around the city with no drivers is something out of a movie. The future is here, Daniel. We are living in it. It'll soon be just another mundane part of our lives that we take for granted, to see these self-driving cars all over the place. I know that I think they're coming to DC next year, which is the area I grew up in, and they're going to be all over the world probably in the next 5 years. But for now, it just feels so innovative and exciting. And I can only imagine how many semiconductor chips are needed to power these vehicles. And obviously, that's only going to ramp up over time. Waymos are only going to expand into more cities and have bigger fleets. And all of that is incremental new demand for TSMC.
Absolutely. And you said it before, TSMC used to rely on smartphones, and that still makes up a third of their business. But what we are seeing with this diversification of growth engines, with AI and high performance computing leading the way, this diversifying shift also reduces the cyclicality, which we've seen in the semiconductor industry for quite a long time. And when you look at all their customers and the fact that only TSMC can provide all those services, it feels like they're actually the bottleneck in the semiconductor industry. And that's a great position to be in if you are TSMC.
My main concern is that if the AI hype cycle ends up looking anything like the dot-com bust, where everyone got way ahead of themselves about new technology, then that pullback could be damaging for TSMC, even if long-term the promises of AI are legitimate. we're in such a dynamic period right now. All we can really do, I think, is just be humble about what's going on and how quickly things are changing. But up to this point, the TSMC story otherwise sounds almost too good to be true. They've got the tech lead, they've got the customer trust, and they're sitting right in the middle of some of really powerful secular growth trends. And the part that we cannot ignore is the geopolitical risk. For all of TSMC's strengths, it has that one glaring vulnerability. Almost all of its production happens in Taiwan. And in today's world, Taiwan is not just a manufacturing hub, it's also, unfortunately, the scene of one of the biggest geopolitical tension points. And we've already scratched the surface of this a little bit in our Alibaba episode way, way back. And while I don't expect that we will find an answer to a question that simply doesn't have answers, we still have to address this risk, especially today, since this tends to be the reason why many of the best investors in the world have bailed on TSMC or just never owned it. And for example, Buffett bought a stake in TSMC back in 2022 for about $4 billion and sold it again after just a couple months. And we know that that is very untypical for Buffett. It's very unlike him. And I guess it just shows that he didn't feel comfortable owning it. Maybe he was losing sleep after buying it. I don't know. Something got him out of it.
Yes, Buffett praised the company a lot, but it proves the famous saying, at least to me, that you need to own a company to actually know it. I've experienced that multiple times, and it seems like it has been the same for Buffett here too. And I guess he looked at the company and he just couldn't resist buying it. I mean, few companies fit the phrase a wonderful company at a fair price better than TSMC. But the fair price is accompanied by a tail risk that could result in a total loss. So you cannot really say there's a huge margin of safety here, no matter how the financials look. And Buffett addressed this, although in his typically reserved way, in the 2023 shareholder meeting. And it's probably best if we listen to him directly. So here's the clip.
Taiwan Semiconductor is one of the best managed companies and important companies in the world. And there is not, and I think you'll be able to say the same thing 5 or 10 or 20 years from now. I don't like its location, and I've reevaluated that. I mean, I don't think it should be any place but Taiwan, although they will be obviously opening up chip capacity in this country. And actually, one of our subsidiaries that we got in Allegheny is participating in their Arizona construction activities. But we would rather have the same kind of company, and there's nobody in the chip company. There's no in the chip industry that's in their league, at least in my view. And the man that was a 91-year-old or so that connected with it, that I think I played bridge with, and in Albuquerque, and marvelous people, marvelous company. But I'd rather find a marvelous people. I won't find it in the chip industry, but marvelous people and marvelous competitive position and everything. I'd rather find it in the United States. I feel better about the capital that we've got deployed in Japan than in Taiwan. I wish it weren't so, but I think that's a reality, and I've reevaluated that in the light of certain things that were going on. Charlie?
Well, my view is that Warren ought to feel comfortable if he wants to.
It's just typical Munger how he only said 1 or 2 sentences, but you immediately get so much from it. I think he would have held on to the position if it were up to him, but Buffett was seemingly not willing to take the risk that a worst case scenario could wipe out their investment, which is ultimately the biggest threat to compounding wealth over time, is having some kind of major wipeout that just sets you back. And actually, funny enough, I was there for the 2023 shareholder meeting, which was Charlie's last. And in fact, there were definitely a few questions that I can remember related to TSMC and just people trying to figure out, rightfully so, hey, what caused this pivot? And My gut feeling at the time is it's just none of the answers were all that satisfying. As Berkshire shareholders, we really did not get a lot of resolution on this one.
I mean, to be fair, Buffett in the last couple of years has kind of made it a habit to build a position and then sell out of it pretty quickly. So we don't know exactly what happened with his TSMC position. We can only speculate it has been because of geopolitical tensions. That's also what they mentioned. But one of our other portfolio companies like Ulta Beauty, we also invested in and sold out of it pretty quickly. So we never really know what is their thought process with these positions. But we also touched on this whole topic in one of our calls in the intrinsic value community, and it just showed me how important it is to gather opinions from many intelligent people and diverse backgrounds, because both of us talk about it every now and then, not every day, but quite often. And when we then can also hear a dozen other opinions on it and look at angles that we haven't yet considered, it's just extremely helpful. And maybe to summarize the China-Taiwan situation very briefly, in case any listener isn't aware of what we're even talking about, Taiwan is a democracy and it operates independently despite many people having Chinese roots. It's not a part of China and it doesn't want to be a part of China. And the Chinese government sees that a bit differently and has made reunification with Taiwan a long-term national goal. And China has repeatedly held something like military drills close to Taiwan, violated their airspace, and run cyber attacks. And China also said it would consider military action to take control over Taiwan if no peaceful reunification can be achieved. And by now, TSMC is making serious efforts to diversify globally, building new fabs in Arizona, in Germany, and also in Japan. And the Arizona project is by far the biggest, $40 billion of investments that will likely turn into more than $100 billion in the years ahead. And the Arizona plants are supposed to produce not only those older, less quality nodes, but also those high-end nodes. And that should already start in 2028. The investments in Germany and Japan, those are smaller, and the focus will lie on nodes for the automotive sector, consumer electronics, and also industrials.
I almost wonder if this expansion, for as good as it sounds, isn't a good thing for TSMC, because, if you have all this almost trapped expertise in Taiwan, and then all of a sudden you start diffusing it around the world, I wonder if long-term that ends up kind of planting the seeds for new competitors building on TSMC's expertise in different pockets of the world. But that's just kind of an out there speculation. Obviously, with these global expansion plans, even still, the majority of the most advanced production will probably stay in Taiwan, I think. And I mean, we just talked about how incredibly complex this process is and how TSMC built an entire ecosystem around its factories in Taiwan with suppliers, advanced engineers, and having all these processes perfectly dialed in. So this is not a short or even intermediate term risk that I'm kind of musing on. And if no one else, not Intel, not Samsung, could catch up, even with deep pockets and world-class talent, maybe it's fair to say that it would actually be hard for TSMC itself to just copy and paste that environment somewhere else to try to recreate its own playbook. So even as they expand abroad, how much of the volume for these cutting edge nodes can actually be produced outside of Taiwan, if any, anytime soon?
You just mentioned one of the biggest problems, which is replicating that ecosystem in the US or basically anywhere else in the world will be incredibly difficult, even for TSMC. So we have already seen some delays with the Arizona fabs because TSMC had to fly in engineers from Taiwan to the US to kind of teach them how to go about the machines and all the processes to increase yield, improve margins, and also increase volume. And at this moment, all of TSMC's AI-related nodes are still manufactured in Taiwan. And this is supposed to change in the next years when everything remains on schedule with the Arizona fabs. But even if that's the case, Arizona will only build a single-digit percentage of the entire cutting-edge nodes in the US. And despite sounding counterintuitive, there's also an argument to make that keeping production in Taiwan is actually part of what keeps them protected. There's this theory which is called the silicon shield. That's basically the idea that Taiwan's strategic importance in the semiconductor industry actually deters China from taking more aggressive action. A war would not just hurt the West, but also China, since they rely on TSMC chips to power their own economy as well, although to a lesser extent due to the sanctions that we already discussed. So while TSMC is still allowed to sell to Chinese customers, there are US export controls in place, and especially when it comes to those advanced chips. And one of the biggest impacts was the loss of Huawei as a major customer in 2020, which just losing that customer alone cost TSMC billions in annual revenue. And since then, the rules have tightened further, so limiting what TSMC can produce for Chinese companies using US tools and US technology. So while China still accounts for a decent chunk of TSMC's revenues, there's always been that risk of new restrictions, and that could in turn hurt TSMC's business. But the importance to the West also gives Taiwan and TSMC in general leverage to demand help or protection if the situation with China should get worse. Because Western countries just have such a strong interest in Taiwan being independent and in TSMC to operate freely. And thus, in theory, this should kind of help Taiwan to stay independent. And in fact, TSMC's CEO has said outright that if a war would break out, the fabs would become basically useless. And the people, the tools, the supply chain, they would all be gone. So taking TSMC by force just doesn't work out.
We actually talked about this a bit on a call with our intrinsic value community one time. And after going down the rabbit hole on Taiwan and China and the risks of a US intervention, it just feels like, wow, are we even talking about investing anymore? Like, what are we doing here? If you have to seriously debate the potential of World War III, and not in some like loony paranoid way, but in a legitimate way where the company we're betting on is literally at the center of the discussion around what may or may not prevent or cause a war between the US and its allies in China, it just feels like immediately should go in the too hard pile. I could come up with a bunch of reasons to comfort myself into believing nothing bad will happen. But unfortunately, I had that hope with Ukraine in 2022, and that optimism proved to be very wrong. And look, I know that China and Russia are completely different countries with much different interdependencies with the rest of the world. And so obviously I'm not saying that I expect the same thing here. But again, that experience just really humbled me, at least, to consider that you can't just set geopolitics aside, especially when you have these great power struggles that are unfolding across decades and centuries and are not driven by the kind of rational economic logic that we are considering when we're looking at businesses. So there's just very, very different and complex forces that can drive these things. And I guess this is a long-winded way of saying I'm not sure I feel comfortable always trying to be in that position of explicitly or implicitly making a bet on those forces in a very direct way, where at least with other companies, the impact is a little less direct. So I want to be open-minded here, though, and I don't want to rule out TSMC yet. So maybe I will try not to let my paranoia keep me away from appreciating what is truly an excellent business with TSMC.
I think we will always end up where we have to analyze the risk, and when it comes down to whether one is okay with this ever-looming risk or not. For me, what matters a lot in answering this question is valuation. While the situation is different for a Chinese company, the question also played a role when I looked at Alibaba, and at $70, I was fine with the risk, but since the upside was so large, that just changed the whole conversation. So the question we have to answer now is TSMC's upside equally large to Alibaba back then? And the first thing that we can say is TSMC is not as cheap as Alibaba was, although it does trade at a significant discount to companies that should be comparable, not necessarily because of their operations, but because of their dependency to TSMC. Apple cannot produce its iPhones without TSMC. Nvidia cannot produce their GPUs, and the entire AI industry would come to a halt. For some reason, Nvidia still trades at a PE of 47, Apple trades at a PE of 32, and despite only growing revenues at 8% CAGR in the last 5 years. And iPhones not growing anymore since 2021. So if you believe that TSMC is as important as every industry expert says, I think the PE shouldn't be at 19, especially if you consider its 5-year revenue CAGR of 22% and the net income CAGR of 26%. I mean, there are other factors that play a role here as well. That's completely obvious. And this sort of relative valuation is also always dangerous because if the other companies are just overvalued, then at some point, if they get revalued, the entire investing case for TSMC would break down. But it is an interesting angle to at least understand just how differently the market chooses to price in the risk of this China-Taiwan situation for different stocks. There's this famous saying that during the gold rush, the people who made the most money, they were the ones selling the shovels. And during the AI rush, it might as well be TSMC. They don't care which AI model wins, which company comes out on top, or if the market will be commoditized, as we discussed in previous episodes, because they would make money selling their leading edge products to every company or to every industry. They are always there, and demand for their product will be as well.
Well, okay, I'm excited. Then let's do it. We've done the relative valuation. We talked about the geopolitical risk. We've gone through the whole business. Try and value TSMC. Let's see if there's a way to price in that looming political risk, and maybe you can help me feel more comfortable with it, because I always tend to be a little extra nervous about these things just because of some past investments that I made that were impacted by geopolitical risks. So relative to the actual cash it's generating and likely to generate, let's think about how we can account for that political risk. How did you go about valuing this company, Daniel?
I basically broke down revenues into 3 main drivers. The first one is wafer volume. That's simply how many wafers TSMC actually ships. After a rough patch in 2023, the volumes dropped about 20% due to industry-wide inventory corrections. Things started picking up again in 2024. And TSMC shipped around 13 million wafers. That's up 7.5% from the year before. And 2025 will be a lot stronger. And the second driver is the mix shift. Every year, a bigger slice of the pie moves to 3 nanometer and soon 2 nanometer nodes. Those wafers cost a lot more than the older nodes. And even if the posted price never changes, just moving share from 7 nanometer to 3 nanometer added roughly 12% to wafer revenue in 2024 by itself. Going forward, I dialed that back to a bit more sustainable 3% per year for mix alone. And again, that might sound very conservative, but it takes time to upgrade to new nodes again and again. So after one new generation, the shift will naturally slow down for a couple of years and then draw back the average. And then the third driver is the price per node. TSMC has a lot of pricing power for the reasons that we have discussed, and a 3 nanometer wafer today goes for about $20,000. For comparison, 5 nanometer and 4 nanometer wafers are typically in the 16 to 18K range. And older nodes go for much less. So even though total wafer volume is still below 2022, TSMC's revenue per wafer has jumped. And that's what helped drive over 30% revenue growth in 2024. And going forward, that pricing trend is likely to continue, especially in the leading edge nodes. TSMC plans on another round of price hikes in 2025 with 4 nanometer and 5 nanometer wafers, increasing their prices by as much as 10% and about 4% for the higher end nodes. So I give them 4% average selling price lift per year. And again, a best case scenario can be higher here, but combined, this already gives us revenue growth of about 18% per year. And that's in line and actually a bit lower than most estimates. And TSMC projects their revenue growth for 2025 to be 24 to 26%. It's more than twice the growth of the broader foundry industry. That kind of top-line growth strongly implies a return to double-digit wafer volume growth, especially with surging demand for AI accelerators and a more normalized inventory environment.
So Daniel, before your pitch, and we just had the numbers pulled up on screen a minute ago, I was not aware of just how good these numbers are. I mean, these are insane numbers. A company of TSMC size should not be growing at rates north of 20%. And if they do, they should not be trading at a PE below 20. You don't see this stuff anywhere in the world. I mean, this would have been like some of the Mag 7 companies a decade ago. Not to say in terms of valuation and growth, not to say that TSMC will have the same results, but just that's kind of the idea here. It doesn't make sense. And I think this clearly reflects that the market is obviously applying a risk premium to this company. I'm not saying anything new with that, but perhaps though it's not fair if we compare it to NVIDIA or Apple, considering their reliance on TSMC. But at the same time, this is not the first time we've seen such a big discrepancy in valuation between US companies and Chinese companies, or in this case, Taiwanese companies. And again, the same argument applies to Apple when we talk about its dependence on Chinese manufacturing for its iPhones. It seems like the market thinks that Apple or NVIDIA will eventually find a different supplier when or if geopolitics become a bigger problem. Whereas with TSMC, the market recognizes, correctly so, that it's just in a much more difficult position to shift its production and dependencies if it needed to in a crisis.
And in the long run, that's probably just true. But imagine these companies struggle to make products for just 4 or 5 years. In the end, the case for TSMC is based on the idea that replacing TSMC will be incredibly difficult. And that's what protects it, both in terms of market position and perhaps also geopolitically. And we already talked plenty about the qualitative factors that show that TSMC must have a pretty impenetrable moat. The numbers paint the exact same picture. I mean, we are still talking about a manufacturer with margins that look like it's a software company. Gross profit margins in the mid to high 50s, operating margins in the 40s, and net income margins in the same region. For the rest of my model, I just asked myself whether I want to model it based on EPS, so earnings per share, or free cash flow. I was asked a couple of times how we decide which approach to choose for what company. So I thought this might be a good opportunity to elaborate on the process because the answer is not always easy. I hope this is not too boring. And for everyone who wants to dive a bit deeper into the models, as always, you can download those models for each company in our free newsletter and in our community where there's a space where you can find and download all the models in just one place. In TSMC's case, earnings per share are a pretty clean yardstick. It already absorbs a lot of capex through depreciation because with TSMC, roughly 20% of revenues flow straight into depreciation, and that's booked, so basically accounted for in costs of goods sold. So earnings per share doesn't ignore the investments that TSMC makes. The upside of using earnings per share is that it tracks the earnings power of the business way better. TSMC reinvests at world-class returns on capital north of 20%. So every new fab more or less immediately grows their business. And that compounding shows best up in earnings. And due to its less volatile nature, it makes applying a range of exit multiples a lot easier as well. Now, the flip side is to turn it around and take free cash flow per share. Free cash flow is brutal honesty. Net income plus depreciation minus every dollar of capital expenditure. It tells us how much exactly is actually left to pay dividends, buy back stock, or pay down debt. The problem is that TSMC's capex is pretty lumpy. In a heavy build-out year, free cash flow looks anemic, and even though that spending is what protects the moat, valuing the stock through free cash flow can make the business look chronically expensive, when in reality, the cash is being plowed into 3 nanometer and 2 nanometer capacity that will earn significant returns later on. If TSMC wouldn't have a huge cash pile of almost $90 billion, and would the returns on capital be lower, then I would argue you should use free cash flow because it's the more honest metric, and it can assess the risk of TSMC not being able to invest into the business, pay dividends, or buy back shares. But since that's not the case, I personally prefer the EPS approach because it smooths the capex cycle without ignoring it. And I believe free cash flow tends to understate TSMC's earnings power if we look only over a 5-year time horizon due to the cyclical nature of the business. If you would model out 10 years, that would be a bit different, but I'm always hesitant to make predictions over such a long time frame, especially in an industry like semiconductors.
Very insightful, Daniel. It's a very subtle point you're touching on. But in certain cases, focusing more on reported earnings can make more sense. And in others, just looking at free cash flow is a better picture of reality. And to me, that's one of those things that is the hallmark of a sophisticated investor like yourself, Daniel, of thinking through what version of the numbers is painting the most accurate picture of reality. And then I'm going to focus on that. I've seen that you still include free cash flow in your model, though. I was just kind of looking through it while you're talking and kind of just to double check whether CapEx and dividends can be financed by the cash that TSMC earns, I'd imagine. So it's a good compromise to still look at both. And doing all of that, what do you say? What does your model suggest for an intrinsic value and a fair value? And how attractive is the opportunity with TSMC in your opinion?
So using a 12% discount rate to account for the significant risk coming from geopolitical tensions and an exit multiple of 25, which to be fair is higher than today, but I really think this company is worth it. Well, then we would get a present fair value around $190. So basically today's price. Due to the dividend payments, we could expect an annual return of around 14%. And as always, this is just an estimate based on my assumptions, and this is not guaranteed in any way. Change up some assumptions and you can get totally different results. But based on this, TSMC, at least in my opinion, looks really attractive. Even at an entry price of $220 on paper, you could still achieve a double-digit return.
I think it would be interesting, Daniel, to see in your valuation and maybe rather than just doing a higher discount rate, actually trying to add in a weighting where you say, okay, let's say there's a 5% chance that TSMC's factories get destroyed in a conflict and the stock basically goes to zero. And how does that affect the valuation? Because really, the company maybe doesn't deserve this high discount rate just based on the quality of its earnings in a way. I know we use a higher discount rate with Nubank, but that's also because, this is a company operating in an emerging market where there's some concerns about the quality of their earnings and the financial risks they're taking by making consumer loans to lower income populations in an emerging market, not to relitigate that whole conversation. And with the point being, though, Taiwan is a very developed country, and this is as high quality of a business as we've seen. TSMC's clients are companies like Apple. So on paper, the earnings are just, they're high quality. The only thing is you have this black swan risk. And I don't know, as I'm trying to think about it in real time here, I'm not sure whether I feel that adding a 12% discount rate is the right way to account for that. Just to push back on you a little bit, Daniel, I would almost prefer, and maybe you did this already, I don't know, but maybe I would almost prefer a scenario analysis where I kind of explored what the company might be worth if you use a more normal 8 or 9% discount rate, like we typically do for the high quality, large cap companies that we look at that we feel like have good moats, and actually just show the effect on the current valuation. If you had this kind of sensitivity analysis of where you said, okay, with X% chance of the company going to zero in a worst case wartime scenario, how does that affect the present valuation? So if there's a 25% chance, a 10% chance, a 5% chance, and maybe a 1% chance, and it's kind of up to the investor to decide what the range of probabilities looks like, which again is why everybody can look at this and come up with totally different numbers for what they think TSMC is worth today. Because obviously a 25% chance of the company going to zero, where you're like, you think there's a 1 in 4 chance in the next decade that China invades Taiwan versus a 5% chance. The math is just very, very different, obviously. And personally, I'm not going to pretend like I know the right percentages, but it's helpful to say, okay, even with including a seemingly very high probability of a truly worst case scenario, if the stock still looked undervalued, that would just be very, very compelling to me. And so my question for you, Daniel, is did you do anything like that?
I actually did that. And it's also because on a prior call in our community, we actually discussed this approach back then for a Chinese company, but I thought, why not apply it now? So to once again quickly explain why I also used an approach where I just increased the discount rate, I did that as one way to account for the heightened risk, because you can use the discount rate as a way to figure out how much returns market participants expect from a stock to get compensated for the risks if you backsolve it. Of course, under the assumption that it doesn't come to a black swan event. This helps to understand what discount investors apply to TSMC compared to, for example, Nvidia and the Apples of the world. But getting to your method, what I did is that I estimated the probability of a total loss, so basically the worst case scenario, which would be a military conflict between China and Taiwan, and then I calculated the compounded probability of a complete loss over 5 years. You could also use 10 or 15 years, whatever the time horizon you want to use. Of course, the longer the time you forecast, the more the likelihood of a total loss compounds and the lower the fair value of the stock. And since we're now accounting for the Black Swan event explicitly, I use an 8% discount rate instead of the 12% from before. As you can see in this table, at everything below 2.5% probability of a total loss, today's price still represents a significant upside. At around 5% you reach today's price level, and at 10% likelihood of a total loss for each year for the next 5 years, that will result in a downside of about 28%, or an annualized return of about 4%. These probabilities might sound low, but personally, I wouldn't consider a 5% likelihood every single year going forward as low. And since I was already in the process of modeling, I also created a quick 3-state model that accounts for a third scenario, which is neither a total loss of capital nor the status quo. Essentially, a scenario of severe disruption without total loss. Maybe China takes over Taiwan and the stock crumbles, but TSMC can actually still keep producing, or they have already diversified enough to keep international fabs running. There are no boundaries to your imagination here. I just assumed a salvage percentage of 35%. So if you want to change any numbers, or you want to see how different probabilities change the stock's fair value, then you can download it for free in our newsletter. When there's a 3% disruption probability and a 1% wipeout probability over 5 years again, then the fair value of the stock would currently be about $200 per share. I know all of this sounds somewhat arbitrary, but it may help you give a sense of the risks and how they impact the valuation.
That is very, very interesting, Daniel. I think that would kind of change my inclination to invest in something like this if the implied probability of loss has to be that high for it to be a negative expected value bet. I think I could get around to being willing to bet on the quality of a company like TSMC, while also betting that the odds of a worst case scenario are, let's say, lower than 15%. And I don't know, I can't believe I'm really saying that because I really do believe the point of investing is to minimize the risk of total loss. But I can see it's so tempting why TSMC is attractively valued and it's such a great business. And I've talked to a lot of people too who are really smart about semiconductors and are like, hey, like this company has a moat. And to some extent, you're kind of deferring to other people's expertise, which is okay. And the other thing is that, we can size the position accordingly. And that's another way to manage the risk. I'm going to say, go ahead and guess that we don't want to make this a 10% portfolio position. We might not even want to make it a 5% portfolio position, but I don't know. How do you think of it?
TSMC is such a phenomenal business that it might be worth taking some extra risk on this. They are diversifying operations, and it's strategically so important that it's in the best interest of pretty much all countries to keep them running. And yet, if one believes China is taking Taiwan over by force and that's imminent, no expected value math could justify an investment. Personally, I feel more confident with investing in China than in Taiwan, just because it feels like Taiwan is this pawn between China and the US. In a scenario of more threats, the world and especially the US can sanction China, and that's what you often say, the risk for an American of not being allowed anymore to own Chinese stocks is definitely there. And that's also a risk for a European investor or everyone outside the US, but it might be slightly lower. So for me, the main risk to focus on is an escalation and pretty much the beginning of a war. And what then happens is that I think China and Chinese companies will likely survive. And it's so important, China is so important for global trade, that I don't see the same isolation happening that we have seen with Russia, for example. Taiwan, on the other hand, does not hold such a strong position. Another, although to be fair, smaller factor is the always looming risk, and that investors apply a constant discount to TSMC's value because of that. That discount can be higher in times of more uncertainty, and it can be lower when the overall relationships between China, the US, and Taiwan improve. Since TSMC is priced cheaply, but not to the extent that investors currently expect an immediate conflict, investing at current prices implies that one does not expect major further turbulences going forward. I would be fine with taking a 2% position to buy a phenomenal business and keep a close eye on the situation. But I know that you're more critical of the China situation than I am. And even I have relatively strong concerns here. So what do you think?
I'm not going to bury the lead. Up front, I'll say I think I can get around to doing that. But then just for the sake of just putting everything out there, I will maybe say some of my concerns. And obviously we've talked a lot about the China stuff. And to some extent, people who know me might say it's somewhat intellectually inconsistent for me to endorse Taiwan, an investment in Taiwan here, because at various points said that I try to avoid Chinese companies, and not necessarily because I think that they're going to, there's imminently going to be a war between the US and China, but there just seems like there's a lower threshold there where, you could have some kind of fallout in relations, where I could imagine a scenario where the US and China aren't maybe at war, but there's some sort of sanctions being levied, where even if these Chinese companies are undervalued, at least from an American's perspective, you could still be penalized. And there could be some sort of sanctions that make it difficult, if not illegal, for you to own, maybe not even all Chinese companies, but specific tech companies, for example, like if you're investing in Alibaba or Tencent. And so that for me is really the concern with China, is not that they say anything bad about these companies or to even bet that there's going to be a war between the US and China, but just to say that there could be a lower threshold where the US government, as for me as an American, makes it painful for me to invest in these companies. And with Taiwan, I look at it differently, because I don't think the US is going to sanction investing in Taiwan. And so truly, it would have to almost be the worst case scenario. So I see the risk reward as a little bit different, and where I see the risk is actually being a little bit greater with Chinese companies, where you have the risk of a war, but also you have the lower threshold of just some sort of like targeted sanctions that could impact you as specifically an American investor. What really kind of puzzles me with this investment, or gives me pause, is to think about the fact that for anyone who's read The Innovator's Dilemma by Clayton Christensen, I think the semiconductor industry is literally the example that they use of the fastest changing industry. And this is something Buffett has always talked about, of when an industry is so fast changing, even the widest moats can disappear on relatively short time frames. If you're investing in a company on a 50-year time horizon, then, a fast changing industry that like semiconductors is literally the textbook example of perhaps the most dynamic industry in the world, where, competitive advantages can be the most short-lived. That really gives me some almost more anxiety than the geopolitical situation with TSMC of, okay, I don't know how to underwrite the quality of their moat. And then on the other hand, as we've kind of seen with Adobe, it's like, Adobe is this great company that has dominated their niche for over 30 years. And so the same is true with TSMC. Is for as fast-paced as the semiconductor industry is, TSMC has continued to dominate. So that's a really long way of saying I have concerns, not totally sold, but I think I could get on board with a 2 or 3% position. And as we continue to learn about the company more over time, continue to get more comfortable with the risks, we may exit the position if we're not sleeping well at night, or we might double down on it.
How about we do a deal? We already mentioned that there are quite some experts in our community on this sector, and I still wanted to talk to some of them. What do you think, if we still have some time until this goes out, if we still talk to those industry experts, perhaps we're both getting sold a bit more on the moat, and why TSMC, even in an industry like semiconductors, can remain on top like they did for decades now. And then we have or decide on our final portfolio position when the newsletter and this episode is coming out.
Okay. That sounds good to me, Daniel. Yeah. So we, for context, we typically record the podcast maybe a couple weeks before we end up writing the newsletter. So, well, I guess we'll have the final decision in the newsletter. Make sure you sign up for that to actually see the conclusion here. And it is a free newsletter, and we condense a lot of the information that we do in the podcast into it, give it out for free to the world. It's about a 10-minute read once a week. And you can find the sign up link in the notes below or at theinvestorspodcast.com.
We had a lot of technical details today, and I hope it has been an interesting pitch nonetheless. But now it's time to wrap it up and to get finally to the easier part of the pitch, which are once again your hints for the audience about the next episode.
Okay, well, we've had a lot of fun digging into TSMC today, but yes, the train keeps moving forward, Daniel. No breaks for us. We on to the next. So I will be sharing another company that is also sensitive to war and societal tension, but in a very, very different way. And I'll also say that this is not a high quality compounder in the same way. And the last hint is that the company is very cyclical, but the cycles are not necessarily not economic cycles. And I'll give a bonus hint. And if anyone doesn't want the bonus hint, just skip ahead like 15 seconds right now. Okay. And so the bonus hint is that the company has a truly iconic brand name spanning back to the days of the Wild West. Okay. So that was the bonus hint. And it's probably too much of a giveaway, but please leave a comment if you have any guesses.
All right. So now I will leave you with a quote from, of course, Warren Buffett. And he said, quote, "Time is the friend of the wonderful business and the enemy of the mediocre." TSMC definitely belongs to the first category. Buffett still didn't come around to give it a long time in his portfolio. Let's see how this will turn out for us. Have a great day.
And on that point, Photoshop has been the industry standard for 40 years. And at any time, you could have probably convinced yourself that some new competitor or technology would upend Adobe's leadership. Right? Like, I don't want to sound like somebody who doesn't understand the innovator's dilemma and how companies can be disrupted, because that does happen. I mean, in reality here, we're talking about a very long runway of dominance, and they've only continued to invest in making the service more powerful and just compounding their advantages, further entrenching Photoshop's position, for example, as the industry choice for image editing software.